Hey, Marty, and everybody, welcome to Texas. DFW is a beautiful place. I'm here in Austin, so miss y'all and sure to see everybody soon. As they say, the best for last, and honored to have a rock star panel. So I'm going to share a brief introduction and leave it to the three gentlemen I see on stage, and then of course San in New York City. Dan Kryzanowski here. I'm with VV Capital and Bridgeview Real Estate. A lot of you Dallas folks probably know Steve May. He's a long time guy in the real estate space. We're a multi-strategy across DFW, closing out on three things now. A single asset DST in the Dallas Design District pays about a 1.8 MOIC, some short-term land in Corpus Christi, about a 20% plus annual, and then finally a triple net industrial fund across the great state of Texas. So I'll share that, and likewise the LinkedIn for all of my colleagues here on the chat. So with that, love to just go down the line, gentlemen, for just a brief introduction, and then we can go forward. And so I'll, for our live audience here, do you want to kick it off, David, and then go down the row?
Sure. I'm David Drumm. I'm a partner here at Carrington Coleman, whose offices we are broadcasting from. And I have been with Carrington Coleman for 42 years, hard for me to believe. And during that time, I've been doing real estate transactions throughout, and currently am co-leader of our real estate transactions practice group.
My name is Peter Powers. I'm a second generation member of MPI Family Office, which is my family's investment office. We're based in Tampa Bay, Florida. I run the real estate platforms for my family. My family transitioned about 15 years ago from the healthcare space. We had diabetic care facilities and transitioned to a family office. We still have a number of diabetic care facilities, but we've really built up our real estate platforms, mostly workforce housing, affordable housing, senior housing, and self-storage. Can you hear me? So apartments, senior housing, and self-storage. So we have about 7,000 apartments across the country, a dozen or so senior living facilities, a nice portfolio of self-storage, and a number of other businesses across the U.S.
My name is Andreas Bremer. I'm the president and CEO of International Capital. We're a company, a smaller investment boutique here based out of Dallas. We deal mainly with international capital, which is mainly sourced from Europe, from the Far East, or from Latin America. We invest according, custom tailored for the families here, either into triple net product all across the US. We also develop multifamily, provide JV equity for suburban surface park transactions, mainly here in the Texas larger cities and in Florida. We have currently 3,000 units under management, in total roughly $1 billion of assets that we manage for German and other international families here.
And San? San, you're on mute.
Hey, thanks, Dan. And I wanted to thank Marty for the invite. I had the opportunity to speak in person in New York. I just want to say for the folks that are there in person, do go to the dinners and do networking. It's amazing. And the only reason I'm not there today is because we had a deal closing in New York today. But my name is San Ng. I run a group called Skytian Capital. Tian just means sky in Chinese, so merging the two cultures. And we're an investment company. We celebrated 22 years in June. We do invest in different asset classes. So in the past 3-4 years, have been very heavy on the multifamily. Peter, I'm surprised we haven't met yet. We are most active in Tampa. Today's deal that we closed, actually it's our 7th deal in Tampa in the past year and a half. So look forward to the discussion.
Awesome. Great. And San, I'll stick with you. One thing I loved about, first of all, your LinkedIn profile, I think is great with the use of emojis and everything else. It really shows a true, global investor with real estate and everything else. Love to learn a little bit more about your 10 Cs. I think that'd be a great interest to kick this off.
All right. So you're howling at my age. So I call myself an investorpreneur 1.0. Really worked for corporate for a few years in strategy consulting and for private equity firms. 2.0, I was an entrepreneur, started half a dozen companies, primarily in tech and consumer in North America and Asia. And then 3.0 have been really managing money, both third party as well as our own money. But during COVID, I had the opportunity to write an investment book called The 10 Commandments of Investing with my nephew, who is a senior at Columbia, with my daughter, who is a senior in high school. And the 10 Commandments is really not Stan's or my family's commandments. It's really the commandments of a number of investment wizards that we study over 12 years and finished during COVID in terms of how they invested. What we found was they all follow these 10 commandments, which we now call the 10 C's. And so currently the book luckily made the Wall Street Journal and USA Today bestseller. Since you did ask, Dan, I'm gonna just quickly show the background here to do a bit of advertising. We do donate all the profits to the book to financial literacy groups, but essentially we follow the 10 C's to invest, and have been doing quite well with it. Thank you for asking.
Absolutely, that's great. And thank you for the comments in the chat. I'm eyeing the chat and the Q&A. So Gudrun, and hopefully I pronounced that correctly, shares that many advisors say they don't invest in Texas and Florida. Prices too high, weather problems, grid problems, etc. David, you share that you've been obviously in Texas, majority of your life, 42 years involved in real estate. What's your take on Texas, maybe vis-a-vis the rest of the country?
Well, I think there's still a lot of opportunity here. I saw a piece where we were leading the nation in commercial real estate, activity, but in dollar volume so far year to date in 2022. And, I think compared to West Coast or East Coast, just on a per square foot product value, we still compare pretty favorably. We probably don't quite have Manhattan rents yet, but we're a lot closer to it, than we were 10 or 20 years ago. I think we're blessed with abundance of energy, both oil and gas, and increasingly wind energy. A lot of people may not know Texas is the #1 wind energy producer in the country, as well as being leading oil and gas producer. And so far, we still have adequate water resources, which I think is a big factor, and pretty decent transportation infrastructure, despite, few snarls here and there. I'm bullish on Texas in general and Dallas-Fort Worth in particular, and can't think of a better place to be a commercial real estate practitioner.
That's wonderful color. Thank you so much. Andreas, take us across the pond. What are you mentioned Germany, kind of what are you seeing in Europe? What's the mood right now?
Obviously, the mood in Europe right now is very somber. At this stage, due to the Ukrainian war, to all the issues that follow with that, energy prices not tripling, but moving up tenfold. That means a lot of businesses, from bakeries to glass manufacturers, are going out of business. A lot of people are anticipating that it will be an extremely rough winter with a very severe recession. What that means is that those families that are affluent and liquid enough, they are looking to diversify. And what we see is that they look to go outside, not only the Eurozone at this stage, obviously the UK had its wild volatility, they are really looking to come to the US at this juncture. So Germany is very fertile climate for people that want to invest here, diversified. They are looking to build portfolios. Particularly the larger families have very ambitious plans, what they are looking to do. They have strategic plans where they look to allocate basically non-correlated portfolios here into the US. And they are looking for stable assets, which is kind of a core element in their portfolio, triple net assets that are long-term holds. They buy them typically unlevered due to the very low interest rates in Germany. They are choking when they see US interest rates. And on the other hand, they are developing to have the upside from entrepreneurial opportunities. And those opportunities remain to be plentiful here in Texas.
You mentioned just to follow up, the low interest rates in Germany. Do you think folks outside of the Eurozone will be looking to have euro-denominated debt?
Certainly. I mean, they will be looking to that. Obviously, the Eurozone can be very attractive right now. The effect that we're having due to the high interest rates here is that the dollar has gotten incredibly strong. We're at 98 cents, which really is, for European standards, roughly 20 cents too high. Which Europe looks like an interesting opportunity. We saw this morning that TPG announced like a $6 billion fund that will invest in the US and in Europe. There will be plenty of opportunities, obviously, over there as well. but it will take a while for them to come to fruition. Right now, what we see is that rents cannot be increased in Germany, that unemployment will go up, the recession will be much more severe than here and much more pronounced. So you will need to be very careful in selecting which asset groups you are pursuing in which markets. And structurally, as people before have found out, it takes a long time to basically improve multifamily assets in Europe because the rent provisions, the protection of renters is much higher, much more cumbersome. It's very difficult to get to the value points that people like Archon and others have assumed to find there. So we think it will be hard work for those people, and it remains very attractive here to look to the US.
Great, Peter. See you looking good in the middle. One thing I've heard recently, you have a consortium of wealth, which just sounds fantastic. Can you share a little bit more on how that has been, in the last few years?
Yeah, so I'll give you the start of it. So my family, as I mentioned, transitioned from healthcare to formulating our family office, and it took a number of years. We spent millions of dollars building our team. Finding the right advisors. Let's say you want to find the right tax advisor. You'll go through 3 or 4 groups before you find the right group that has the same and similar vision as you and can really take you to the next level. So those aches and pains that led us to become a family office, losing money in the markets, and then the healthcare business not being as advantageous as it once was, and our learning to really build up this team. We kind of said to ourselves, we spent all this money, it took us all this time, why don't we share this with other professionals? So other groups that maybe own, have a huge medical business, or maybe other businesses. They don't understand what a family office is. They, lost, some business, or they lost a tremendous amount of money during, 2008, or maybe other cycles. They want to diversify, formulate their own family office. Let's leverage our team. Let's allow them to, leapfrog the learning curve. So we started, opening up our family office. So we're a little bit of a disruptor in that sense, because we share our strategies, we share our deal flow. So we've formulated this what we call our consortium of wealth of other, ultra high net worth families, entrepreneurs with fast growing businesses, and family offices. So we have families, from 50 million to a couple $1 billion that we share our strategies, share our deal flow with.
Great. Stan, want to go back to you. We've touched on a lot of the world. I know you have some strong ties and color on China. Can you share what is going on there? What's the views been of different, say, high net worth investors, family offices, and particularly the folks boots on the ground in China?
Yeah, thanks, Dan. So I did run a number of VC funds for 17 years out of Shanghai, investing in different assets. I want to say I'm definitely not an expert, because if you leave China for a year, you're no longer an expert in China. But I'll give you a couple of stories. I think from an asset standpoint, especially real estate, I think it's positive. Just in the past 3 weeks alone, I've had one friend who runs 10 figures long equity, Hong Kong and Chinese equities. He was really hoping that there would be a softening of power in Xi. That obviously did not happen. I had a friend call me last night in Shanghai asking how to immigrate to Canada. And then we share this. I have a friend who is a divorced single man in his early 60s in his WeChat group where he socializes. He has had multiple offers from wealthy ladies asking to marry him to help bring capital outside of China. Now, these are all true stories. I think what's happening, and you saw the article yesterday, the stocks in Hong Kong and China tanked. I think there will be a lot of capital looking to leave China, looking for a safe haven. So it's another driver, I think. There isn't a lot of safe haven assets in the world. We've looked at and invested in many asset classes. We think that a chunk of that will eventually find themselves into US real estate, in particular multifamily and some of the other assets that Peter's family owns as well. So,
and you mentioned multifamily, so I want to keep it with you, and then also David and Andreas. Share a little bit more about multifamily. Do you feel this is strictly US, this is the Sun Belt, the Midwest, or is this more of a kind of a global phenomenon?
Yeah, well, I left China and my funds business in China when I was 45. I took 5 years off, and in those 5 years, I traveled the world, looked at different things, invested in some 30 blockchain projects, looked at all kinds of different things, wrote that book. And when I turned 50, I decided I got to do something with my life, post 50. And long story short, I felt that for my family, and we're about 75% allocated to US multifamily, this to us is still, we call it the holy grail asset, the best risk-adjusted asset class for cash flows, for wealth appreciation, preservation, tax mitigation, all the shebang. And we still see that despite the current macro environment. In fact, in spite of it, and we're doubling down on that as well, for a lot of reasons that I think other investors do multifamily.
Really good. No, great advice. David, Andreas, what's your take on similar question on multifamily?
Well, Andreas and I work on some of the deals, and so we overlap a little bit. But on Andreas's deals and others, the multifamily product has been a higher percentage of my practice the last 5 years than any other time, and it seems to be, what's really hot right now, because I think there's several factors that contribute to that. One is obviously with rising interest rates. You have fewer qualified home buyers, and therefore more renters, assuming you have the population. I think a lot of the younger people, the millennials and Gen Zs, I think they don't like the economic investment, don't quite believe in the American dream home ownership the way the boomers did. And, they would rather rent than own, and have the portability that goes with that. And I think there's been a real mindset in the municipal regulations. It used to be that none of the cities wanted apartments because they were worried that the wrong kind of people would be sending kids to schools. And, they had a certain image in mind of what an apartment resident was like. But I think as the product has improved and you find more luxury products, that stigma has largely gone, not entirely, but largely gone away. And you're getting more of a red carpet for these developments we have a lot of local governments in the DFW Metroplex, something like 76 or so, and can't generalize too much, but I think on average, they're a lot more receptive to permitting multifamily than they have been in the past. And there's a new trend that some of you may be aware of, which is the build for rent housing that is also red hot right now, which would involve a product that looks a lot like a single family home, but whereas single family subdivisions would be developed with individual lots, platted lots that could be bought and sold, that these are traditionally on or emerging on one big lot, and they have the same kind of shared amenities as an apartment complex would, like the pool and the game room and those kind of things. But they are not even capable of being sold like a house is, because there's no individually owned, even a condominium has an individually owned unit. These just have a footprint on the ground that you're entitled to possession of. But that product is remarkably strong. What do you see, Andreas?
Well, I think it's fair to say that for a German investor, for a European investor, it's particularly appealing here that you have these very efficient to manage units, which is highly unusual in Europe. You typically don't have 300 units that can be rented together, that can be managed together. One of the significant benefits here is the non-judicial way to basically deal with any payment defaults. If you have a tenant in Germany, you have to pay to move him out of the apartment, you have to pay the truck to get him out of there, and you have to find him a new apartment. That is quite different here. That is very refreshing for them, and they feel that this is a great way how their money ought to be treated in Germany as well. They like the diversification of having 300 tenants and being able to have a heavily diversified cash flow. And they are intrigued, obviously, by the exit opportunities, which are stretched so far here, that gives them a unique opportunity to dispose of the asset at the end of its holding life. One of these things, Germans are obviously scared of inflation because they have been in the last century twice through events that have devalued their currency completely. So they are used to put basically CPI clauses into leases. And if you buy, any kind of long-term leased property, the US is not really used to that. The maximum that we have is like 2% annual increases, but Germans like to be directly tied to CPI. And obviously rental units are one of the great ways to get that, because the landlords typically have the pricing power in the long run to recoup whatever inflation has occurred. So that gives them comfort. They feel they are in a flexible asset that is able to adjust to the inflationary pressures that we're seeing, and where they get value at the end of the day.
Hey, David, just to follow up, I'm sorry, please.
Dan, if I may, love what I'm hearing from the esteemed panel. You know, Goldman did a survey early last year, 150 family offices. I think the smallest is 100 million. 20% have 6 billion plus. So a lot larger than we are. And at the time, they said 22% had allocated to real estate. It is my belief. I'm trying to get updated numbers that the allocation has increased because of the macro environment and the discovery, really the chase, the hunt for safe assets. Given the U.S. dollar is still the base currency, I think there'll be more capital chasing that asset class. Yesterday, I also just finished listening to Blackstone's earnings report. I'm not sure if you guys heard that, but it's quite interesting. Obviously, Blackstone, I believe, still is the largest real estate owner in North America, if not global. They're certainly one of the largest. And they're extremely long-term bullish, according to John Gray, in multi and workforce housing. And in particular, a lot of things the panel said: low inventory, lower vacancies. Just be careful with leverage. The fundamentals are rock solid. So they're definitely smarter money than we are, but the smarter money is basically also betting, doubling down this asset.
Mm-hmm.
Thank you.
Sure.
Dan, is there anything I want to add a couple things? So everything that was just mentioned is 100% accurate, and that's a big reason why my family is involved in it. But really, the primary driver is one. You look at what's going on right now in the financial markets, and yeah, interest rates have gone up, but having Fannie and Freddie gives us a tremendous amount of liquidity. So that's number one. And number two, just look at the affordability problem. You look at that, those are two giant ingredients that really make this just a great, investment vehicle. Investing in this, seeing that, there's a tremendous amount of households across the US that really don't have much disposable income, aren't making, nearly as, their incomes have not increased like rents have. 20 or 25% of households are spending over 50% of their income towards rent. That's a real issue. So, over the past couple of years, we've been noticing, I guess over the past 10 years, we've been noticing that, our rents have just been, jumping up in, some of these big cities like Dallas, like Phoenix, like Tampa Bay, where rents were $500, $600, $700, and now those rents are 2.5, times that. And household incomes have not gone up. So we've been investing extensively into these tax credit properties, these low-income housing tax credit properties, into acquiring hotels across the country, converting those to apartments, because there's a huge unmet demographic of people that just they don't have a place to live. I mean, it really is sad. You see, every city I go into now, you just see the homeless population is increasing and increasing. There's a bunch of reasons for that, but one of the main reasons is they just cannot afford to live, in cities like this. So, I just had a meeting with a pretty prominent family office and a very, very large multifamily developer. And, we were just having that discussion, and that's exactly what they're seeing. I mean, they're at a time like this, they're doubling down on their development. Like it's so much in need, we need to build more and more of it, and it's a supply issue. So, we're trying to do our part, converting these hotels, but, we're barely putting a dent into these markets. So, you have those are really, that's what's really fueling our thesis in terms of devoting more of our time and effort towards multifamily, opposed to, asset classes like retail or office. So I wanted to add that was, that's the main driver for my family.
And if I could tag on just briefly, you're also seeing conversion of downtown office buildings in Dallas to multifamily use as well as the hotel conversion. So yeah, there's active conversion of a lot of bricks and mortar that has been serving other uses to multifamily housing.
Yeah, I'm sorry, Dan. I just what Peter said is also very important to us. Peter, these are much smaller projects, but the deal that we closed today is a third one in downtown St. Pete. And really, we see the same issue, affordable housing. There's a huge supply issue. So what we're doing with this third building that we've acquired is converting it into a flexible leasing and co-living spaces, just to really meet this immense demand in places like downtown St. Pete that have a huge shortage of supply.
Great. So from the spirit of the panel, it seems that obviously multifamily workforce housing, there's a lot of factors that make it like a pretty strong investment, pretty wise investment. One thing I haven't heard was development. So I'd love to get everybody's take on, is development attractive now? If not, is it something, for example, down here in Texas and New Braunfels, especially impact fees where, back of the napkin, if you were paying $1 million, if you missed the cutoff, I think end of year, end of January, you're paying $9 million. So you have to think, do you go forward with the deal? So are you guys all in 100% with, we'll call it value add, or would you consider a ground up development?
Yeah, a lot of the deals Andreas and I've worked on are ground up developments. We've worked together on about 5 of them or 6 of them
Yes,
over the last
exactly.
Yeah.
Yes. Ground up development has obviously for us several benefits. It's much cleaner. It requires less traveling of the families. If you buy a value add property, the families have to come out. For a development deal, it's much easier. They can do the demographic analysis from home, and they can do kind of portfolio investing because it's a clean slate. The demographics are there, and you can show comps and clean exit rates of other comparable properties. The other factor is obviously that the value add properties are difficult to buy because you go typically through the auction process, and that is difficult for a syndicator to aggregate the funds and not then losing out. That makes it tedious, whereas in a development deal, you can develop a pipeline and you can off that pipeline, go there. The big benefit in that case for the family is if they know we're signed up for a transaction, they are sure that they get their slot that they want to have. Makes it much easier, much more efficient for them on their side. And last but not least, as we see now with the interest rates increasing, it's much more difficult for the value add properties to distribute funds because more goes to the senior debt. Then it's just a question, how strong can the property be until it can be sold then?
So one thing I want to add, we really do focus on workforce and affordable housing. It's nearly impossible to develop affordable housing. I know we're saying things ever impossible, but at the end of the day, we have to make money. So we've looked into development. We've done, I think, 2 developments over the course of our, we own 7,000 apartments. We've only done 2 developments. So that's what's led us into the conversions. We're like, all right, you have existing products. While you're going through the, changing the units, you can lease them up on monthly leases. You could still do that. It's a lot more risk averse, but if you look at your all-in basis, it's still extremely attractive, which allows us to offer rents that are 15, 20, 30% below nearby comps. And that's, and those comps over the course of, the conversion, that the rents keep going up and up and up. So that's where we've been focusing. Again, we feel way more comfortable in that space, but I think, and we're starting to see in Tampa, you're starting to see some of the big groups come in, related and such, where they're teaming up with the city, and they are, kind of doing some sort of public-private partnership. So I think it's attractive if you go about it that way, but just a normal development, we just can't make the numbers work. So we've been staying out of it.
And Peter, I'll keep it with you.
Cost-driven.
You said my favorite words, making money. I know you're also involved in senior care and my favorite, self-storage. In the interest of time, I'll let you just pick one, but what are you more bullish on between senior care and storage? And, if you can share with the audience the why behind it.
Yeah, I mean, I definitely would say over anything, we love multifamily, but really is right now the growth for us is in senior housing. So we've been in the healthcare business for about 30 years now, really catering towards seniors. We've seen, the whole evolution of senior care, and you look at the demographic, how it's growing, there's a huge need for it. And right now, your biggest issue getting into multifamily is just the cost. I mean, you can't make sense of the numbers. Well, I won't say the beauty of senior housing, but it got hit really hard during COVID. So you can really find some really attractive assets in areas and from, types of deals I never thought we would buy. We're buying institutional quality deals from REITs, from some of these giant, institutional players that need to reshuffle their portfolio, whether it be they have a number of assets and they need to get, rid of a few of them, or they're closing out the fund. They extended it during COVID. Occupancy for a lot of these went down to high 50s, 60%. Now it's back up to, the mid 80s, low 90s. You could find some extremely attractive deals. At the same time, it's not the best time to sell a deal because of where interest rates are. So we're finding that some of these groups have to sell deals at a time where it's just not the best time to sell. So we're acquiring assets really across the country in the senior living space, private pay senior living. So that's what led us into it. And that's why we're extremely bullish on it. Just given, the next 10, 20, 30 years and given, the current opportunities that are presenting themselves to my family.
Well, I've got one you can look at, and this is not proprietary because it's right on the front page of the Dallas Morning News business section, but the Edgemere, which was long the premier senior living facility in Dallas, has been in Chapter 11 for about 5 months, and the judge has given them a deadline. Judge, who is actually one of my former partners, has given them a deadline to come up with a plan, or the bondholders get a plan, and they would love to find a buyer for that one. So there's your tip of the day.
I mean, just from my side, obviously on the senior housing side, one of the concerns is that international and here German investors in particular wouldn't like to be on the front page of the Dallas Morning News that people have to be moved out of complexes, which gets me to one point that is very important for them. That's an amazing thing, is ESG. And I know that here it's poo-pooed in the US and it's sort of not as popular, but it's an important role for us. It's basically the affordability component. It is the social component. It is what else do I do? And families frequently ask for what is the impact of what I do? But with regard to senior housing, a true concern is that they say neither skilled nursing nor senior housing works because we don't want to kick out elderly people and then say German investors are basically moving against, Americans here. That's one
thing I want to touch on with the ESG. I mean, I could appreciate if it makes sense. I mean, look at Germany right now. It's horrible. And a lot of those really extremely wealthy families they're buying places in Spain. They're buying places in different areas. It's just not working. You're closing down your nuclear energy plant. I mean, it's just not working. So you need to have we would love for it to work. And I think there's a lot of people in the US that would love for it to work, but at the end of the day, it needs to make sense. I mean, what you just said, when you have energy costs going up tenfold and people have to close their businesses, and that's it's going to cause a real issue with employment. It's going to cause a real issue in terms of housing because they don't have jobs anymore. So I don't think, we haven't even had that discussion. I haven't heard that discussion much, is, how it can really have that domino effect and how much of a real, impact, if you just fully go towards some of these clean energy initiatives, which I think long-term we'll get to, but there's a transition process. Yeah.
Marty, you have a question, please?
He's muted, Dan.
Marty, if you want to type it in, if you're in front of the group. As we get to that, Stan,
I'm gonna repeat the question for the audience.
Please.
Okay, the question has to do with, I think, two questions. The effect of regulatory constraints and the effect of supply chain constraint. No? Okay, regulatory environment for these projects.
I keep it simple because we're developing in Florida and Texas. We're benefiting, but there's a reason why we're here. Obviously, in other states, that may be quite different.
They act like they care and they really don't. I mean, it's true. I mean, you come out and look at California. I mean, what do you say about that? Oh yeah, let's do all these beautiful things. And then the people that are saying that, they're the ones that end up saying, oh, not here, not my backyard. I mean, it's blunt, but it's true.
Yeah, I think what you see in North Texas and Dallas, and particularly in the city of Dallas, would admit this, that it's not conscious anti-growth, regulation or anything, but they're not getting the permits in all cases through fast enough just through, I think a lot of it's personnel constraints and those kind of things, budget constraints, but they would love to give permits faster. The delay in permits is actually getting some appetite for development. Well, I think what Andreas, the biggest wild card in a couple of our deals was the lumber price, right?
Right.
You want to talk
Absolutely.
about that? Yeah.
Lumber is obviously more a national component. You know, that's not a state component. Lumber seems to be more like a market-driven thing, and it wasn't not necessarily the owners of timber, but it was the sawmills, it was the distribution chain afterwards. And so there were price elements that were very difficult to control. And it led ultimately to the fact that in max price contracts, that lumber was carved out because the developer simply said, we're not able to commit to a certain price point that needs to be left open. So these type of things occur. I think we had one other transaction where diesel, out of some reason, was left out. So, yes, price points, max price contracts, that can be difficult. And the other question, if you talk here in Texas regulations, obviously the availability of land, the tightest spot, you know, the materials are there. You probably can get the appliances. You will be able sooner or later to get the things that you need. But we have here communities in Dallas as well that are saying we have now enough multifamily for now. And they basically establish for 12 months, 24 months moratoriums where they will permit new multifamily transactions. That is a regulatory hurdle that obviously is tedious for the developers. And some of the most important people in the larger developers is the people that are securing land for development, because they need to work through these pipelines. They need to schmooze basically with the P&Z committees. They need to figure out how do we get the land rezoned and basically converted into living space. I guess so. Yes, exactly.
I would say labor. I mean, labor is your biggest issue. It's not necessarily the cost. It's just you can't get the people. I mean, I don't do much construction, but we have a lot of partners that do. You have your construction crews, you know, especially like in an area like in Dallas, right? They're working, they're doing a great job, and then guess what? There's a new development that might go on a couple miles down the road or a couple streets up, and they'll come to your people and they'll pay them a couple extra bucks an hour. And guess what? That's a real issue. It's not just the cost, but also it's the time. Now you got to find more people. So these projects end up getting, you know, just kick down. I mean, it just takes longer and longer and longer. At the end of the day, it's time, value, and money, right? I'd rather get that project done in 18 months instead of, 24 months. So I think that's the issue we're facing with our conversions right now is, yeah, we have crews that go from city to city, but that could really delay you with some of your subcontractors if they don't have the crews that they used to.
And ultimately, the biggest issue of all, basically, and that's, I think, the 800-pound gorilla in this, is illegal labor, right? I mean, that's the market has relied on illegal labor for a time. ICE has enforced a lot. It's very difficult to fill positions here because this market is so undersupplied with qualified labor.
Great stuff, guys. Can I take it back here?
Sure.
A lot of talk about meat and potato, real estate, regulation, et cetera. San, I want to go back to you. I know you've touched on blockchain, stuff that isn't, as I said, kind of down the fairway, meat and potato, whether it's tangential, blockchain, or maybe even non-real estate. What do you like? What are you most bullish on for your investments in 2023?
Yeah, I actually keep it very simple. Remember, I took 5 years off, call it a sabbatical, call it a midlife crisis, to talk to a lot of people that are much smarter than us to write that book. Right now, we are, for our own capital, 70-75% in real estate, primarily multi. I still love that asset. We are actually launching our Fund 3. I guess it's the first time we publicly stated it. We're launching another vehicle to acquire more. It's a co-GP fund with a few select GPs that own 20,000 plus stores. And the idea is that we think that the market hasn't bottomed yet. In places like Tampa, maybe we're seeing 15-20% discounts, but probably in the next 6-9 months, we're going to see a bit more better chances to buy. So we really want to bring up the dry powder. The rest of it, my second asset that I love is anything Elon Musk touches. So we're extremely heavy long term with Tesla and SpaceX. And then we have a little side pockets here and there to do certain blockchain and technology projects. Keep it very simple. I don't have 40 assets. I really have less than a handful of assets, but we know those assets extremely well. And we have studied them and have religion on them, following the 10 C's, and just keep churning away.
That's great. So gentlemen, we're at the probably about 5-minute mark. So for folks online, any questions, please come through the chat or the Q&A, and Marty, feel free. But with that, I always like to share. I've been on many panels also. Sometimes it's there's always that one thing that you wish you can share, and then poof, we hit time. So, with that, and thank you, Marty, we've been granted some more time. So just wanted to connect for everybody's schedule around the world. So take some more time here. So this is exciting. So, with that, Sam, I want to just keep with you, and then we'll bring back to our guys in Dallas. New York City, I hope a lot of folks have traveled, but there's different views on COVID and such. What's your take on NYC? Is it still the hot place, or do you still feel from New York and San Fran, I'll put them together, Chicago, et cetera, people are still moving to either other parts of the Midwest? There was a question on that, the Sun Belt, et cetera.
So I've lived in 12 countries, Dan, not traveled, actually lived, bought places or signed leases. New York, one of them. I'm a firm believer in places like New York and Shanghai. Those long-term will do well. And about 4 months ago, we made a bid for a Chelsea multifamily, and I regret myself for not being aggressive enough to purchase that. But yeah, I think if you try to book hotels or book restaurants in New York and places like that, it's booming. But in terms of the scale of investment, I agree with the panelists. The net migration megatrend are to tax-friendly, landlord-friendly, employer-friendly places like Texas and Florida, and so our capital is really chasing those deals.
A similar question for the guys in Dallas. We talked a lot about the U.S. Where are there golden nuggets outside of the U.S. that you would consider, whether it's for just sheer economics, politics, regulation, et cetera? Where else would you consider going?
Strategically, one of the places where people go is Switzerland, even though there's no returns. In Switzerland, cap rates are 1%, but Switzerland is a big destination for a lot of wealthy families because it's extremely well structured. It's extremely important. People from Latin America, from Russia, from a lot of the Mid-Eastern countries, Switzerland is their key destination. That is, I think, for reasons obviously of hedging in these uncertain times. It is for reasons of having your nest egg basically in a location where you're 100% sure that it's protected in the maximum way. That's just, this is not to get rich. This is basically wealth preservation thought.
Got it, great. We had a question come in here on hotel conversions to micro apartments, quadplexes. Is this something you guys are seeing? Have you considered underwritten it? What's your take?
We're doing a bunch of hotel conversions across the country. We're probably one of the most active players. We bought 2 towers in downtown Baltimore earlier this year. So there'll be 715 hotel rooms, I believe, we'll be converting to apartments. But again, at the end of the day, people can only afford what they can afford. So yeah, a lot of people get caught up that they're 300, 400, 500 square foot units. And yeah, that's small. But when either you're coming out of college and you want your own place to live, or if you're a senior on fixed income and you're not ready for a senior housing community, it's a great place to live. You're in great locations. You take common areas, you make them into amenities. Our all-in basis is extremely attractive, even going through the tough times that look like they're ahead. When your basis is I think we're going to be all in at around $160 a square foot. You can't build a 23-story tower for less than $400 or $500 a square foot. So our all-in basis is extremely attractive, which is very defensive on our end, and we're providing something that's very, very much in need.
Dan, I can.
Yes.
Yeah, Dan, we have a few projects.
Crazy demand, yeah.
So yeah, we have a few projects, not hotel conversions, but we're buying older buildings in places like downtown St. Pete, and we're we're calling it branded furnished flex leasing. So we actually brand it. There's a theme to it, and we add amenities as Peter does, and then we make it flexible leasing. It could be 3 days, could be a year. And in places like downtown St. Pete, we have traveling nurses, we have entrepreneurs, we have some folks that are displaced from Hurricane Ian from down south to come up, and we're finding great. If a studio on a long-term unfurnished was $1,500 a month, depending on it's month to month or shorter term, we're getting north of $3,000, $3,500 a door. Obviously, the OpEx increases, but we're providing both the supply service and the need, but also additional profits for our investors. So we're looking to scale that model up as well in other markets.
Yeah, depending on the jurisdiction, I think that's an area where the regulations, may or may not have caught up. I know McKinney, Texas, which is north of Dallas, they permitted one shipping container, to housing conversion for some smaller units. And I know the city of Austin made an exception to their platting ordinance to allow a lot for a rear house that might have been a servant house or a mother-in-law quarters, that as they had a housing shortage. And so, but I think there are other cities that haven't yet, that you simply can't get the micro housing because it's not a recognized zoning product. So I think, what does that stand for? Okay.
ADRs.
Mm-hmm.
I mean, it's typically pretty small for us. I mean, can you just fourplexes you're talking about, just 4 units? Are they, I know, but they're like, okay, so it's not like 10 of them in a row. So it's just a fourplex. That's too small. So we probably wouldn't put too much time into that. Okay.
I haven't seen that much of that yet, but maybe it's coming.
Yeah, we haven't seen that. Right. We've seen that in Colorado, actually. In Colorado, in the mountain regions, ADUs are common because the house prices are getting so high that the affordability is compromised. And then basically the ADU allows those homeowners to afford the unit further. They qualify easier. But then the home prices go up to 1.2, 1.3 million as well. So that's up in Eagle County. And that's an active way to develop these areas.
Yeah, I just saw some data on LA and San Francisco. ADU laws passed, and there's been a blossoming of units being built in both cities. We also have some properties in Toronto. Same thing happened, and St. Pete in Tampa were heavily also 2-3 months ago passed ADU laws as well. I think it's a big trend, and it's an opportunity for developers in that space. Can one of the folks in person repeat the question, please?
Sure. The question has to do with short-term rentals. And if you want to elaborate, go ahead. Okay. Short-term rentals with branding of a national brand to upgrade the value. Yeah.
No, typically not. I mean, typically not. And I have a feeling that cities like Dallas, like some of these places are more aggressively moving against that. We see neighborhoods moving against it. We see issues coming up. And a lot of cases, the credits have been not strong enough to really justify those people.
Yeah. You definitely have HOAs moving against it. There's a lot of them in Dallas. I know from personal experience, but I don't know if the city has cracked down as much as it could, but it's a hot topic among HOA associations right now.
Yeah, I mean, I think it's an interesting business for sure, but I mean, you can't get the typical leverage. It's not the same capital going towards it. And it's arguably more of a business than it is real estate. It's very management intensive. So I think it could still work in a lot of different areas. I know we've looked at it on a number of our conversions of Why go through all these headaches when we're already getting crazy appetite before we even convert them just on the 1 month leases. So maybe we just, instead of going through all these headaches, put a little bit of money into the community, make it look nice, and just do these 1 month leases on, because typically there are 100, 200 keys, right? So 100 to 200 rooms. So that's something that we're looking into. Again, it's cheaper, for us. Our basis is even lower because we don't have to put the kitchenettes in. Maybe just put a master kitchen with a few different stoves and stuff in a certain area so they can go and cook. And just put like nice microwaves in, but keep it simple because there is, again, people need a place to live, and maybe some of those people, their credit isn't good, or maybe their criminal background isn't that good, so they can't live in these apartment communities. So maybe that's an option for them. But I could see it as a solution in certain areas, but we haven't explored it in depth yet.
Peter, follow up to that. Are you seeing self-storage become a natural extension of, especially for renters, something that they plan to budget in? And if so, are they going to the traditional storage facilities or to, say, an adapted Kmart or something that's been refurbed in the last year or two?
Well, I think it's a great question in relation to the conversions, right? So if you have a 300 square foot unit, where are you going to put your stuff? I mean, we have a place we're outside of Boulder. A lot of people like to mountain bike or they like to kayak. It's a great question. Well, what we do is we have 50,000 square feet of, common areas. We're gonna make a lot of that amenities, but we'll also make a good portion of that storage space. So they can put, some of their bigger materials there, and they don't necessarily, they don't have to go outside of their community to a storage area. It's right inside the property. So that's what we've been doing. That's kind of a solution. Like we have this deal in Baltimore. I mean, if you'd see the size of this ballroom, we're going to have half of it as a sports court. The other half is going to be storage for these people. So it's been requested, and we're seeing it lease up very quickly alongside the actual apartments that lease up.
Marty, any final questions from the crowd, from the in-person? Good. All right, great. So I'd love to just go down the line for 1 minute, kind of the big takeaway of the day, or if there's one thing to share with your audience, something that you just got to remember to take action on.
Well, I'll say what's made it interesting for me the last few years is the new type of real estate products that keep coming on, and I think it'll only accelerate. I mean, I practiced a long time before I had heard of a data center or a cell phone tower or an Amazon distribution center. These attached dwelling units you're talking about. I think the real estate market is going to continue to get creative on products, and I think there'll be a lot of success in kind of being an early adopter of some of those products. So that's kind of what I'm interested in.
Our biggest almost idea, but it's definitely proven itself out more and more now, and it's where we're putting the most emphasis is what is the true business plan? What is the true value add for any of the real estate? I think for the past 10, 15 years, with rates going down and all the money going into the different real estate asset classes, you could just sit there, sit back and you'd produce crazy returns. And you do that for a number of deals, you produce a healthy track record, and you can raise more and more capital. So I think what you're seeing now is you really need to execute a business plan. You really need to focus on, this is where the value is. This is what I'm going to do to achieve that, instead of, oh, we're buying it at a discount and, we're going to put countertops in and cabinets and we're going to rebrand it. Like, that sounds good, but at the end of the day, you actually need to have a true business plan. You need to truly infuse value into these properties instead of just the market appreciation.
I think from my side, for those families that are particularly looking from the international side into the US, I think it's important to find strong allies that are domestically well connected in the markets, that are able to find the best possible deals, that are clean, that are easy to judge from the outside, have high quality partners in those deals, keep the leverage low, and try then to pursue your strategy by diversifying your risks. Don't over concentrate in individual locations, cities, or deals, but keep the overall portfolio well diversified The US obviously is a market that in the long run will provide a lot of opportunity, but it is volatile. And you want to be in a defensive mode. You want to have liquidity events in between so that you're able to reposition, to decide what you want to do. A lot of things are happening here that are sometimes difficult to predict, like we have it right now all over the world. But I think the real estate that we're discussing here between storage, between multifamily, provides great platforms to basically be defensively invested and create long-term wealth.
Stan, we'll leave the last word to you, my friend.
Oh, great. Thank you. I think time horizon is important. I think ignore the media headlines, distress down. There's always FUD and noise out there. In the end of the day, with real estate equities, if you look at the past decades in America, it doesn't really matter. Interest rates are not high today. There's been times where interest rates are much, much higher. Housing prices always go up. Equities always go up. Berkshire Hathaway always makes money long term. So as long as the deal pencils out, today's rates or the entry cap rate, exit cap rate don't bother me as much as an asset. Does it cash flow, and can we hold on to it for long term? So we try to keep that mindset when we purchase. We're actually more excited now to acquire more multi than we were 6 months ago, a year ago, just because as some of the panels, it's become less competitive. The deal that we closed today, Colliers appraised it at 54.5% higher than my purchase price. Right. So obviously we have a less favorable debt, but I'll take the equity any day. So yeah, think long term, and as long as it pencils out, keep at it. And lastly, I put up my book again. Just to those that are interested, we do available everywhere, and we do donate all the profits to charity. Thank you.
Well, guys, this was a wonderful way to close day one. I'm going to kick it back to Marty. And if anybody's in Austin, Texas, find me. Drinks are on me. And please reach out to the panelists on LinkedIn. We'll pop it in the chat again.